Let's start with inflation. It is high and has been for months. From December 2020 to December 2021, the Bureau of Labor Statistics reports consumer prices rose 7%. That's the largest percent change during a calendar year in more than 4 decades. That price increase is taking a toll on consumer confidence and could potentially eat into your hard-earned paycheck. But what causes prices to increase so sharply? It's simple economics, supply and demand.
Inflation.
You've probably heard that word a lot recently, but what exactly is inflation?
So inflation is a persistent increase in the overall price level or the aggregate price level. So it's not the change in the price of an individual product. It's when prices overall are going up.
Here's where the basic lesson in economics starts. Coronavirus cases have been on the decline recently, and the economy is starting to recover from the pandemic-induced recession. Households are consuming more and spending more, whether it's due to money saved during the pandemic or a recent wage increase.
At a certain point, we might push against the economy's capacity to produce, and so prices might start going up. So we cannot produce more. Instead, we're going to see prices going up.
Demand for goods is high, and manufacturers are struggling to reach pre-pandemic levels of production. Simply put, supply isn't able to keep up with demand. That means suppliers are able to increase the price of their goods with relatively high assurances that people will still purchase. The Consumer Price Index tracks inflation, and this past year, the CPI ballooned to 7%, the highest it's been since 1982. The U.S. government calculates inflation on a monthly basis.
They survey U.S. households to decide what is it that the average household consumes, to come up with this representative basket of goods and services. And then they track the value of this basket over time, and that's your CPI.
So what does this mean for your budget?
It reduces the purchasing power of your income. If your wages were to increase in line with inflation, of course, then your purchasing power would not decrease.
If your wages aren't increasing, though, your money won't go as far, and it may be harder to afford day-to-day items. The good news, experts predict inflation rates will eventually go down. It just depends on how quickly manufacturers can increase supply.
Our baseline expectation is that supply bottlenecks and shortages will persist and elevated inflation as well, and that as the pandemic subsides, inflation will decline from today's elevated levels.
Experts say in order for inflation numbers to subside, suppliers need to ramp up production to meet current market needs.